Good morning. I'm going to talk to you about Chapter 16, just the highlights of it. You can read the book, but make sure you print off this and have it filled out. These are the probably more important items that I need to talk about so you have maybe a better understanding of. But please note there's a lot of other materials in the chapter that is also important and are subject to testing. Okay, so it's your responsibility to read the chapter. And that's where we gain some experience in reading. So we're going to talk about management accounting. I'm going to let you read through some of these, but basically you should have taken financial accounting at this point in time. So you have the basic idea of what assets, liabilities, owner's equity, revenues, expenses are. That is a given in this class. That's base knowledge that you should have. So we're going to switch to management accounting, and we're going to understand why it's different from financial accounting. And so you can kind of read through the basic framework of that we need maybe a different system internally and why we need that different system internally. Okay, and so this is the one I'm going to start on what the difference between financial accounting and management accounting is. So please put these in your own words, saying the book's words. There's no magic to the book words. Pick up a book, different book, you have different words. So I want you to understand it in your own words. So the purpose of financial accounting, honestly, if we focus, I'm going to skip to this one. If we focus on the users, a lot of these will become self-explanatory. So the users of financial accounting are external parties, investors and creditors. So think about the decisions that investors and creditors would make. Investors would want to compare firms, one firm to another firm, to decide who they're going to invest in. Creditors would need to decide if we need to lend them money. Investors and creditors might want to compare past performance, et cetera, et cetera. Whereas managerial accounting, the users are internal decision makers, and internal decision makers might want to determine what they need to sell a product for, what they need to add to the product, how the East Coast is doing versus the West Coast, to figure out who they need to spend advertising on. And so once you get the user groups, external versus internal, a lot of these can become very self-explanatory. Okay? So since the users are external, basically we want to provide financial information about the performance. And notice this is very broad here. However, for managerial accounting, think about the decisions, planning and evaluating, rewarding performance. I don't know that I'd put sharing with outside parties, just information that's needed, but that's certainly not the focus of it. But I need to plan, so budgeting is going to be in this chapter. How to cost a product is going to be in this chapter. Bonus situations are going to be in this, I should say semester, not chapter, etc. So the types of reports, since we're going to compare one firm to another firm in financial reporting, is very standardized. You need a balance sheet, income statement, statement of cash flow, statement of owner's equity. However, management reporting, since it's whatever management wants. So if you need a report that simply identifies how we did last week, that's what you're going to have in your report. So they're various non-standard. Since I have comparisons made between companies, the companies have to prepare their financial statements based on some rules so we understand it. So they follow generally accepted accounting principles. There's no standards for accounting, management accounting. However, we do base things off of GAAP. So I like to make the parallel between financial accounting and managerial accounting in like sports. Okay, so let's say that we play football or basketball or some sport. If we're going to invite other schools to attend and play against us, we need to follow a formalized set of rules. And those formalized set of rules say things like how many players can be on the court, how long the game is, how points are awarded, et cetera, et cetera. So in order for you to prepare to come and play, we need to know the rules, because it would be pretty ridiculous if we did professional or college or high school sports, in that when you invited another school in there and when they came, you handed them the rules. So today we're going to play with a a 3-point line that is at the half court, or we're going to play with 0 3-point line, but you get 3 points per basket, etc., etc. However, I like to think of managerial accounting as practice. So notice that if you're playing basketball, you don't tend to practice basketball with a football. You tend to practice basketball with a basketball. So the rules in managerial accounting are based off of GAAP. However, you can alter them as you see fit. So in practice, if we wanted to encourage 3-point plays in basketball, because let's say we had some short players on our team, and we wanted to practice, we may decide that there are 0 points given for layups. That would in practice. So if you're putting one team against another in practice, if 0 points for layups, no one's going to do a layup. There's no incentive to do it. So we can change the rules in management accounting to fit the needs of the report that we want. Okay. Next one, what part of the business do the reports cover? Since investors invest as the company as a whole, since investors or creditors lend money to the company as a whole, the financial reports are as the company as a whole. So, for instance, PepsiCo owns Pepsi, Tropicana, Frito-Lay, etc. So you can only buy stock in PepsiCo. You can't buy stock in Tropicana, so the company as a whole. However, certainly, under management accounting, PepsiCo wants to know how Frito-Lay is doing, how Tropicana is doing, so we can break it up as we need. Again, whatever management wants is over here. Time periods, since we're going to compare, we need to have them usually formals, because I don't want to compare one company's 12-month performance against another company's 18-month performance. And again, management, whatever question they want, is the time period it answers, and we've already done the users. Okay, so those are pretty important. These you can read yourself. There are certain certifications that you can get. And I don't really have anything to add there. Please read these as they're important, but nothing that I can really add to them to make you understand them better. So this is the first thing that you should define, and we'll come into these later. But sometimes problems ask for prime costs. So again, like sports, if you were going to say field goal, okay, we need to understand what that means, and it differs between basketball and football, certainly. But there are a lot of things that you just need to know the lingo. And that's really all it is, so you can communicate. So prime costs are direct materials, direct labor. Conversion costs are direct labor and manufacturing overhead. If you haven't read the chapter yet, first of all, you need to read the chapter. But watching this beforehand may help you read the chapter more fluently. Conversion costs we'll learn as the two costs to convert direct materials into the finished product, and those two costs are direct labor and manufacturing overhead. Okay, so categories of manufacturing costs. You're going to go down here. What are the 3 manufacturing costs? I wanted your definitions all together. Manufacturing costs, make sure you define them. Our manufacturing costs are costs to manufacture. So they include direct materials, which are picture making a book. It's going to have paper in it. It might have the glue in it, the binding, etc. The direct labor are basically the labor of the people who directly work on it. So this would include usually the people who touch the product. Now sometimes direct labor doesn't actually touch it because they're operating the machine that touches it, because we don't want to cut our hands off or come in contact with maybe poisonous things that are hazardous to us. But anyway, so it would include the wages of the people who are directly traceable. It's not the supervisors, because the supervisor, think of them, they supervise everything. So usually direct labor, we can time how long they work on a product. So for instance, if I'm running a machine that's cutting it, I know how I can time how long it works it on it. And manufacturing this is important. It's just kind of a catch-all. So if you think of a building, a plant, okay? So picture yourself a plant that makes something. Every cost in that plant is a manufacturing cost. It is either direct materials or direct labor, and everything else is manufacturing overhead. So that would be, again, factory is a key word here. The utilities on it, the supervisor of the plant, the equipment repairs, depreciation on the machinery, the cost for earplugs, the cost for real estate taxes on it, the cost for, I said property taxes on it, but on and on and on. Anything you can picture in the plant that goes on is either direct materials, direct labor, and overhead. And obviously, most of the items are overhead since direct materials, there's a finite number of parts that go into a product. There's finite number of people that work on here, but if you walk around a plant and you see it, it is not labor or materials, it is overhead. Okay, so you can see that I'm going to skip down here, and we're going to come back to these. But what are the three inventories on the balance sheet? Notice there's a cost flow. When I buy things, they go into direct materials inventory. After direct materials inventory, they come out of direct materials, hold on, because it goes to work in process to finished goods. So our three inventories are direct materials, work in process, finished goods. We'll come back to that later. But notice how basically I have my direct materials, they go into the manufacturing process. Also, direct labor goes into it. I use electricity, those types of things, and I have finished product. It goes to cost of goods sold. So that's the physical flow of goods. So just kind of picture it in your mind. A good thing to do is like to go to YouTube and how do I make this? So like go to how do I make whiskey, because a lot of the Jack Daniels and different places will show their production process, or how to manufacture a guitar, or two ones that I've done. So kind of go to a how do I use this, and as you're watching the video, think about what is going in directly to the product, who is touching it, and all those overhead things you can see. Okay, so product costs up here. Product costs are costs that go into the product itself. So direct materials, direct labor, and overhead. Okay. Period costs down here are costs of the period. So product costs attached to the product. And you'll find that's important later, because since they attach to the product, and if I don't sell the product, they stay on inventory on the balance sheet. Period costs are costs of the period. So they are always expensed in the period they are incurred. Product costs are expensed when the product is sold. Period costs are expensed in the period they're incurred. So it includes selling expenses, administrative expenses, interest, income tax expense. So notice it is period. Okay, so these are not part of cost of goods sold. That will become more clear in a little bit. Okay, so you can see that inventories stay on the inventory, but when they're sold, they go to cost of goods sold, or cost of sales in this case. This really follows the matching principle, that you don't expense the cost of a product until that product is sold. That's the matching principle. Okay, so we talked about our three inventories. All right, here's our inventories. We kind of showed them before, and I said work in process, and then it didn't show it. So I've got materials inventory. That's things I haven't used. So if I'm making automobiles, that's the steel for the automobiles, the leather for the seats, etc. Work in process are those cars that are in process, are still in the factory. And finished goods, pretend we have an outside location where we store our cars until they're shipped, and that's our finished goods inventory. Okay, so you can see that we have, goes from, this is kind of combining it, this is the one I was thinking of last time, but it goes from materials inventory into work in process. So I'm adding raw materials, direct labor, and manufacturing overhead. So the three manufacturing costs are always going into work in process. Direct materials, direct labor, manufacturing overhead. I assemble them, then transfer them out to finished goods, transfer them out to finished goods to cost of goods sold. So I want you to notice something. In with a debit, out with a credit. In with a debit, out with a credit, because these three are inventories. Inventories are assets. Remove the cost of goods sold. Cost of goods sold is an expense. Make sure you know that. Okay, so you can kind of read through that and see the in with a debit, out with a credit. So please study that. Just because I don't spend a lot of time on it is basically because I think you can look at it yourself. Okay, so here's a greater definition of direct materials, some ideas, a greater definition of indirect materials, which are factory overhead here or manufacturing overhead. Okay, so sometimes indirect materials, usually they're not really used in the products themselves, but they're materials, so bearing, grease, welding materials, cleaning compounds, so the janitor stuff would be indirect material. But sometimes you can even treat insignificant items as indirect materials, mainly because it's too difficult to keep track of. So think of glue. If you're binding a book together, it's very difficult to keep track of how much glue goes into a book, thread that goes into a shirt, those type of things. You can treat as indirect materials, or you can treat as direct materials since they're actually part of the product. But most people, they're too insignificant, so we treat as indirect. Okay, so you can read through those. Direct labor. So these just kind of gives you some examples of direct labor. You can read through those, and you'll read through them in your book. And then indirect labor are things that people who don't touch the product, but they're part of the plant. So factory supervisors, maintenance, personnel, etc. So notice up here, you've already got the definition of product costs and period costs. I tend to visualize these as two buildings. So I tend to visualize we have one building that's manufacturing and one building that's the office, and the sales floor. So if it takes place in the factory, it's a product cost. If it takes place on the sales floor, it's a period cost. Okay, so you can kind of see these. So just examples. Okay. Direct costs are just those, the ones that directly go into a product. So these will define product costs. So product costs are either direct or indirect. The direct ones actually have direct in their name, so direct materials and direct labor. Indirect means they get into the product but indirectly. So it takes electricity to get into the product, but you don't pick up something and get shocked. So electricity is indirect. So all the manufacturing overhead are indirect costs. Note, period costs are not direct or indirect. They are period costs. So these only define product costs. Okay, so we're going to do some of these, finished goods, etc. Okay, so the schedule of cost of goods sold, okay? So really I want you to fill this out, okay? So this is our work in process one. So what I have for work in process, I want you to see something first. Sometimes if I started with something, so let's say I started with 2 pencils, I added 7 more, and the question is, started with 2 pencils and added 7 more. If I had 3 left, how many did I use? Okay, and so hopefully you've just determined 6. So in your mind, you've got available, so I had available 9. So I started with 2, I added 7, I had available 9, and I am left with 3, whoops. And so how many did I use? I used 6, okay? So what happens is really all of these kind of follow this format, what I started with. So let's put them into accounting terms. What I started with is beginning inventory. Okay, so my format for my raw materials inventory is beginning inventory, and how do I add to raw materials? I add purchases. So it's beginning inventory plus purchases. I can't really type and underline very quickly, so I may ditch these, but they're very important. Gives us available. And then I'm going to subtract what's left, and in accounting we have that. We call that ending inventory. Since I'm doing a dash, I'll put minus ending inventory. And that gives me, and again, this is a total, so I'm going to underline that. And that gives me my raw materials used. format for your materials inventory. I'm going to do that format 3 times, but the terminology is going to differ between these statements. Okay, so 1, 2, 3. So the work in process one, and since I'm going to not type here, I'm just going to use theirs over here. Isn't that convenient? Okay, so work in process, what I started with is work in process beginning inventory. So beginning inventory, work in process, plus what I added. Notice that I add, let me see if I can do this, I add manufacturing costs. Okay, so you add 3 things. So this is your added section. I add direct materials, direct labor, and manufacturing overhead. Okay, so beginning inventory plus what's added. In work in process, I add 3 things. I add my 3 manufacturing costs. Direct materials, direct labor, and manufacturing overhead. Now, if raw materials only includes direct materials, that number will be that number. So it's going to feed into it. Okay? Now, sometimes raw materials inventory includes the oil for the machines, etc., etc. So notice that the oil for the machines is part of manufacturing overhead, and manufacturing overhead application is a bit different. We cover that in the next chapter. So as long as raw materials are indeed direct materials, that number will feed into there. If raw materials includes other stuff, then it won't directly feed into there. So make sure you kind of look for raw materials being direct or indirect, etc. Okay, so I have beginning inventory plus what's added gives us available. Okay, they call it total cost of all work in process, which basically means what I added this period for plus beginning. So you can put that work in process available. Minus ending inventory is cost of goods manufactured. So again, what I started with plus what's added gives us available, 840, minus what's left, called ending inventory, gives me what moves on. Okay, and what moves on is cost of goods manufactured. Okay, so make sure you fill that in there. Okay, next one. Cost of goods sold. Again, beginning inventory, finished goods, plus what's added. This is cost of goods manufactured. So I want you to draw an arrow from the bottom of this one into cost of goods manufactured. I think this is the same one. So notice 800,000, 800,000. So draw an arrow from the 800,000 on here to the 800,000 on there if you wrote numbers, or if you didn't write numbers, just draw an arrow into there. That one always will do it. Notice I said this one sometimes doesn't if this includes indirect materials and not just direct materials, but this one always will flow in there. So beginning inventory, what started plus what I added gives me available, minus ending inventory gives me what moves on, and what moves on is cost of goods sold. Okay, the last one is the income statement. Okay, and your income statement should read sales minus cost of goods sold gives us gross profit. So I want you to get that down, and then I want you to draw a line from your cost of goods sold to your cost of goods sold on your income statement. So let me get back up a second. So C 782, 782. Okay, then I have just put operating expenses and then put a little dash, selling and administrative. So sales minus cost of goods sold is gross profit minus operating expenses gives us income from operations. And on operating expenses, put a little dash out there or little lines and put selling, general, and administrative. Basically what general is if you don't know where it goes in general and administrative. Okay? Gives us income from operations. Sometimes I just put the interest and income taxes together. So minus interest expense minus income tax expense equals net income. A lot of times problems won't give you interest or income tax expense, but what they want you to notice is these are period costs. They're costs of the period. Selling, general administrative, interest, and income taxes. So sales minus cost of goods sold is gross profit minus operating expenses equals operating income minus interest and income taxes is net income. Okay, and that's pretty much will get you through this. There's the balance sheet. Notice under inventories, I have these 3 inventories. It will be the ending inventory line on each one of these will be this. So this line would be 20,000. The ending inventory, Yeah, the ending inventory for work in process will be 40. The ending inventory for finished goods. Okay. Okay, so we are done with that. So hopefully you filled that out and this will help you. Now I'm also going to have one with some problems.